Hello, everyone, and welcome back to Deloitte's Debriefs webcast series in Asia Pacific. Very good day to everyone from whichever country you have joined us. Again, we have an outstanding sign up for this webcast. And as promised during our first tax webcast, where we discuss how the new thin cap rules affect foreign investors' investments into Australia. Today's webcast is the second part of our two-part series from our Australia Real Estate Geography Updates series, and it's titled Build to Rent and Foreign Investment Update. My name is Clan Yo, and I'm a tax partner in Deloitte Singapore. I'm delighted to host today's webcast together with Mandy Yao, who is Deloitte Singapore's tax partner seconded from Deloitte UK. We have along with us today 4 presenters: Max Persson, James Patterson, Stephen Smith, and Mimi Song. Max, James, and Mimi are tax partners of Deloitte Australia. Stephen is an Access and Economics partner with Deloitte Australia. You may access our bios on the left side of the screen. Before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. For mobile device users, you can view the slides and answer the screen on screen. Thirdly, if you require an attendance record for this event, you will receive an automated email with CPE certificate after watching for about 50 minutes. Let's have a look at today's agenda and the following topics that we'll discuss. We'll start with the overview of Australia residential sector, followed by build to rent, proposed and existing tax concessions for investors in the new build to rent projects, state taxes, concessions and exemptions, Victoria and New South Wales stamp duty changes to Australia's foreign investment framework, foreign resident capital gains tax updates, and we'll end off with the Q&A. Now let me hand over this time to Mandy.
Thanks, Glenn, and hello, everyone. We are going to kick off with a quick polling question. So the question is, what is currently the biggest hurdle that you see in investing in the build-to-rent sector in Australia? So the options you can choose from are length of time to obtain development approvals. Second, cost of labour and materials. Withholding tax at 30%. Inability to claim GST credits, or stamp duty and land tax costs. So feel free to pick your choice out of the options. And whilst we wait for the results to come in, as Ken mentioned earlier, we held a recent webinar on the Australia thin cap rules. So today we won't be covering the recent changes to the interest deductibility rules, but if you missed the last webinar, you can watch a recording on our Deloitte Debriefs website. So the results are in, and it looks like the top choice is cost of labour and materials, closely followed by withholding tax at 30%, which Max will come on to in a bit more detail. So now we're going to hand over to Stephen Smith, who leads our economics team, to provide an update on the residential market.
Thanks so much, Mandy. My name is Stephen Smith. I'm a partner of Deloitte Access Economics based in Canberra in Australia. I'm going to give a short update on the current position of the Australian economy and also the Australian residential property sector. So if we move on to the next slide, the Australian economy at the moment is relatively weak, like most other economies around the world. In the last couple of years since the pandemic, Australia has been battling quite high inflation, and as a result, the Reserve Bank of Australia has lifted interest rates quite substantially. Interest rates during the pandemic were down at emergency lows of 0.1%. They've been lifted to now be 4.35%, and that 425 basis point increase in interest rates has quite a significant impact on the Australian economy. The largest element of the Australian economy is household spending. Australian households, particularly those with a mortgage, given the relatively large pass-through of interest rates through to mortgage rates via variable mortgage rates in Australia, households with a mortgage are really feeling the strain of higher interest rates and have pulled back on discretionary spending quite significantly. The Australian economy has been in a per capita recession, and consumer spending has really been at the forefront of that. The other sector of the economy which is struggling with higher interest rates is housing construction, but that's also a sector that has been struggling due to some other influences coming out of the pandemic, which I'll touch on in a moment. If we think about the trend path of the Australian economy for the 10 years up to when the pandemic started, and then we think about how the economy has progressed through the pandemic and beyond relative to that trend, we can see now when the top chart on this slide shows that we're now slipped back below that trend path, and those higher interest rates are really starting to bite. Fortunately, though, we do think that interest rates have now peaked in Australia. We are expecting interest rate cuts through the calendar year 2025, and so that will provide some relief to households. As we go on to the next slide, we can see that one of the more significant positives for Australia since the pandemic has been the rate of population growth. During the pandemic, with a closure of international borders, overseas migration turned negative for the first time in Australia. Since the pandemic, that population surge has really helped to support the economy and helped Australia to avoid an actual recession, even though a per capita recession has taken place. Very high levels of net overseas migration have been at record levels, record highs, though that surge is now starting to fall, and we're now starting to see population growth heading back towards more longer-term average rates. What that surge in population growth has done, though, is put a very significant pressure on housing demand in Australia, and Australia is now currently facing a housing crisis. Australia, for a long period of time, has not been building enough homes, and the confluence of factors through the pandemic, from access to or lack of access to work sites, higher cost of materials, the lack of labour and labour shortages has really compounded the sector's ability to produce more homes in Australia. As a result, the government has set a target to build 1.2 million homes over the next 5 years. Our forecasts for the number of dwelling commencements, which is shown in the second chart on this slide, show that we expect that 1.2 million homes target will not be met, and in fact that looks quite unachievable at this stage. We go on to the next slide, just to get into a little bit more detail about what's been driving some of that and some of the consequences. We can see on this chart at the top here, chart 5, this shows the number of dwellings that are under construction in Australia at any one time over the past 60 years or so. The green line shows houses, detached houses, and you can see that most recently the number of detached houses under construction in Australia has been quite high relative to historical levels. In fact, the number of houses under construction has been at the highest levels we've seen in the past 60 years. Unfortunately, that's not a good story. This is not the residential construction sector churning through and producing a lot more dwellings. It's actually a number of dwellings just taking longer to be completed. So we've got a lot of projects under construction at the moment, but the sector having a lot of difficulty in getting those finished off. And so that's exacerbating this imbalance between supply and demand in the residential property sector. Because of very strong population growth and relatively weak supply, the vacancy rate for Australian property has been very low and rental growth has been quite high. That relationship is shown in chart 6 here on this slide. We're currently seeing very low rental vacancy rates and extremely high rates of rental growth in rental prices. That really is the definition of a housing crisis, and is what Australia is experiencing at the moment. But what it also does is provide a stronger incentive for investment into the sector, including through higher rents, providing better returns for landlords and for developers. But it also provides an incentive for reform in areas such as land release and zoning. So whilst we are going through a very difficult period in the residential sector at the moment in Australia, those high rents will in fact eventually start to flow through to a better supply. One of those areas of supply is build to rent, and that's really the subject, build to rent and broader investment, the subject of a lot of the remainder of this webinar. And I'm going to pass over to Max now, who's going to take us through some tax implications in the build to rent sector.
Thanks, Stephen. So we're going to discuss build to rent income tax concessions that have been proposed by the government, as well as existing BTR concessions at the state level. So if we forward one more slide. The income tax concessions were initially announced by the government on the 9th of May last year. There was then quite a lengthy period before any further details were provided in the form of an exposure draft, which came out in April this year, followed by a short period of consultation before a bill was introduced in early June. Shortly thereafter, the bill was referred to a Senate committee for further consultation, and that committee is not due to report until the 4th of September, so next week, Wednesday. However, the application date for the concessions is still proposed as 1 July this year. So what are the concessions? Well, there's two types. The first one is a reduction in the managed investment trust withholding tax rate for active BTR developments, which is a new definition, reducing the rate from 30% to 15% for foreign investors. Secondly, all investors can benefit from an increase in the rate of capital allowances from 2.5% to 4% on construction costs. Importantly, the criteria to qualify for the proposed income tax concessions are not the same as for the various state BTR concessions, and so all of the various requirements need to be considered together. The next slide. The criteria to qualify as an active BTR development are set out on the next slide. Unfortunately, the rules will only apply for projects that commence construction after the announcement date, so the 9th of May 2023. And anything that was under construction or completed prior to that date will never be able to qualify for these rules as proposed. So there's a requirement that there are at least 50 dwellings and they need to be offered for lease to the public for a period of at least 3 years, although tenants can request shorter terms. All the dwellings and common areas need to be owned by a single entity, although the project can be sold to another single entity and still qualify. At least 10% of the dwellings have to meet affordable dwelling requirements, which includes a 25% discount to market rent and tenants meeting prescribed household income limits. The owner is the one that needs to collect this information from tenants to confirm their ongoing eligibility and submit this information to the tax office. It seems like where a single tenant fails the test, the whole project will cease to meet the requirements. However, you can apply to the tax office to permit a temporary breach. There's a measure or a requirement that is meant to prevent you from allocating all the affordable dwellings to smaller apartments, so studios, for example. So the requirement is that you need to have an equal number of non-affordable dwellings of the same type. And lastly, the owner needs to make a choice to apply the concessions. So on the next slide, with these proposals, what will the landscape look like in Australia for investing into living assets? Well, there's currently 3 categories. The first one being residential dwellings generally, which do not qualify for the 15% withholding rate, so the rate is 30%. The second category is what's referred to as commercial residential premises, which includes some purpose-built student accommodation, generally being off-campus, some co-living facilities, as well as land lease or manufactured housing models. For commercial residential premises, the 15% withholding tax rate is currently available. Lastly, there's a category of affordable housing that qualifies for the 15% rate. But because this concession is only available for the affordable housing, we've not seen this model taken up widely to date. So then we have the new proposed category being an active BTR development, where the 15% rate would apply to net rental and capital gains from the disposal of eligible dwellings. It's important to note that it's not 15% on everything as proposed, it's only on rental and capital gains on the dwelling. So income from tenants for services or use of amenities that are maybe split out from the rent would not seem to qualify, and also capital gains relating to common areas or other land that is not part of a dwelling also doesn't seem to qualify. You can also see that the MIT in the proposed scenario is a standalone entity. This is effectively a requirement of the proposed rules currently, which seems to be unintended and is contrary to the way that most funds would be structured, which would involve sub-trusts holding particular properties. This has been raised through the consultation process and is something that may be addressed through recommendations from the Senate committee. So for BTR development ceases to qualify at any time during a 15-year compliance period, a new BTR development misuse tax will apply. The misuse tax is payable by the owner of the BTR development at the time that the concession was claimed. So that could include a previous owner. It's payable by the owner rather than investors, which can result in unfair outcomes where investors have changed over time. The misuse tax is calculated to claw back the value of the concessions that have been claimed. So this would be the difference between the concessional 4% depreciation rate and 2.5%, or the difference between a concessional 15% MOT withholding rate and 30%. An 8% gross up is also applied, which is akin to a kind of interest charge. So while the changes should be positive, there are still questions as to whether the concessions really go far enough to attract significant investment, in taking into account the need to include affordable housing. The heavy-handed nature of the BTR misuse tax may also operate as a deterrent and could create some difficult indemnity issues where a BTR development is sold during the 15-year BTR compliance period. So handing over now to James to talk through some of the concessions and state taxes.
Thank you, Max. So stamp duty and land tax, of course, are state and territory taxes, meaning that the rules, rates, and concessions and exemptions are different in each state and territory. And the build-to-rent concessions are no different. Although, as we will see, there are some similarities between the jurisdictions in this space. Next slide, please. So build-to-rent concessions are offered by the various state and ACT revenue offices as a concession to developers, ultimately foreign-owned developers and foreign investors, to encourage the development of residential premises in Australia. For eligible projects, all jurisdictions that impose a duty surcharge offer an exemption or refund of foreign purchaser surcharge stamp duty, other than the ACT, which does not impose that surcharge duty. And all jurisdictions that impose a land tax foreign surcharge offer an exemption or refund of the foreign surcharge land tax, noting again that that is not imposed in South Australia or Western Australia. In the ACT, a registered community housing provider must offer the land for rent at less than 75% of market rent to tenants that have a gross income below 100,000 Australian dollars. All jurisdictions offer a 50% ongoing land tax reduction for a 20-year period, except for Tasmania, which offers a 3-year 100% exemption, and for Victoria, where the reduction is for 30 years instead of 20. Note, there is no surcharge stamp duty and no land tax at all that is imposed in the Northern Territory. So these concessions don't apply there. So generally, eligible projects are those projects where the developer is Australian-based, so an Australian incorporated entity with central management and control in Australia, majority directors and key management. The only variant to that, if you like, is Tasmania, which also requires that that entity must be based in that jurisdiction. The developer must make a significant contribution to the local economy. That's generally a minimum spend of at least 20 million Australian dollars and the engagement of at least 50 workers on a project. The project needs to be developed on one parcel of land, so one title, and generally the land can't be subdivided. It needs to remain as one parcel for the duration of the period that the concessions are claimed. The one exception to that is Victoria, where subdivision is allowed, provided what remains still qualifies for the conditions. There must be only one management company managing the development, and they of course must be new dwellings. In all jurisdictions, there must be at least 50 dwellings that are constructed, except for South Australia, where 20 is sufficient, and Western Australia, where the number is 40. Importantly, the developers must offer a lease to the tenant that is of a minimum 3-year term. Now, the tenant can request a shorter period, but they must be offered at least a 3-year term. And some jurisdictions also require the below market rental component. We've already mentioned the ACT. Queensland similarly has a requirement that at least 10% of the premises have a rental at less than 75% of market rent. And New South Wales also has an affordable housing requirement. There's at the moment no clear guidance, however, from any of the state or territory revenue officers as to what this below market rent component looks like. Some of the jurisdictions also have unique requirements, and one of those being New South Wales, for example, that needs at least 10% of construction labour to meet certain conditions, such as being long-term unemployed or Indigenous workers. Now, all projects must have an occupancy date that is at the latest between 2026 and 2032, which is dependent upon the jurisdiction. If we go to the next slide, thank you. So this table here I won't run through, but basically summarises what the build to rent stamp duty concessions are in each of the jurisdictions. And the next slide, please. This table summarises the land tax concessions, both during the construction phase and then during the operation phase of a development. Next slide, please. So moving on from the build to rent concessions offered at the state level, for the remainder of my presentation today, I'll provide an update on some of the recent key changes to stamp duty in Victoria and New South Wales that are relevant both to the residential property sector and also to the property sector more broadly. Next slide, thanks. So turning first to the expansion of the vacant residential land tax in Victoria, which will apply to properties that have been vacant for at least 6 months or more in the year prior to the taxing year. So the next slide, thank you. So this vacant residential land tax has been expanded from metropolitan Melbourne to apply to all of Victoria from the 2025 land tax year. And it applies not only to land that is owned by individuals, but also to land owned by property developers via companies or trusts, including build-to-rent developments. If residential land is not occupied for 6 months or more in a calendar year, then this tax will apply. And it's imposed on the capital improved value of the land at progressive rates, starting at 1% in the first year, increasing to a maximum of 3% after year 3. It will also apply to vacant and underdeveloped residential land in metropolitan Melbourne, but that will be at a flat 1%. Now, the land tax liability date in Victoria is midnight on the 31st of December each year. And as this tax will apply from next year, it means the occupancy requirements need to be satisfied in this calendar year, or assessments will start to issue for this tax from early next year. There are some exemptions, notably the holiday home exemption, and there's also a newly built home exemption or concession where they will have the benefit of a 3-year grace period before the tax is imposed. Next slide, thank you. So, however, the most significant change in state taxes in Victoria this year, and potentially from all of the jurisdictions, was the introduction of the commercial and industrial property tax with effect from 1 July 2024. Next slide, thank you. So this tax is designed to replace stamp duty over time with an annual tax on commercial and industrial property in Victoria. Land will transition into the CIPT regime if it has a qualifying use. That is a use with one of those AVPCC codes that are on the slide. There will need to be a minimum 50% interest acquired in the land to trigger entry into this new tax. And that will be subject to a 3-year aggregation period for determining whether that threshold is met. Once it has been met, and 50% of the land is within the regime, the tax will apply to the whole property. The rate is 1% of the unimproved value of the land. And generally, it is the owner who will be liable for the tax. There's also a change of use provision, which we'll discuss in a little detail shortly, which can bring the property back into the duty regime. Next slide, please. Thank you. So the tax is triggered where there is an entry transaction, an entry consolidation, or an entry subdivision. Generally, an entry transaction means when there is a direct or indirect acquisition of 50% or more interest in the parcel of land that gives rise to a qualifying dutiable transaction or a qualifying landholder transaction. And we'll look at these in a little more detail on the next slide, please. So a qualifying dutiable transaction occurs where there is a specific transaction under the Duties Act that involves a direct dealing in the land. That's generally a transfer or a declaration of trust or a vesting of the land. But it also must be a specific interest in the land, so fee simple or a life estate, a crown leasehold, or certain long-term leases. Entry into the tax won't be triggered by grants of certain leases and acquisitions of economic entitlement. The tax also won't apply if corporate reconstruction relief or another exemption from stamp duty would be available to the transaction. And it won't apply if there was an agreement for the transfer entered into before the tax commenced on the 1st of July 2024. The aggregation rules are similar to the rules under the Duties Act now. So they'll look to things like similar vendors, similar purchases, the use of the land, the time over which the transactions occur. But importantly, this has been extended to a 3-year period rather than 12 months as what usually applies for stamp duty. A qualifying landholder transaction occurs where there's a relevant acquisition for landholder duty under the Duties Act, that is, an indirect dealing in the land. All the other rules, similar to a qualifying dutiable transaction around the type of land or not being applicable where there's corporate reconstruction relief or another exemption, apply to the landholder rules as well. And the aggregation provisions are also similar, including the 3-year period. But note, because landholder duty applies to a 20% or more interest in trusts, landholder transactions involving property held by unit trusts, for example, may continue to see the landholder duty apply without transitioning the property into the CIPT regime. So if we move to the next slide, thank you, we'll have a look at a practical example of this from a transfer duty perspective. So assume here on the 1st of July this year, a 10% interest in land was acquired. Then 2 years later, on 1 July 2026, a further 40% interest is acquired in the land. It's within the 3 years, so the CIPT aggregation rules are going to apply. We've had a 10% plus 40% acquisition, so 50% interest, and we'll move into the CIPT regime. The entry date will be the 1st of July 2026. That is the date of the last transaction that caused entry into the caused the 50% threshold rather to be breached. And that means that CIPT will apply from 2036. 10 years after that date, with the first assessment to issue in early 2037. So even though in this example, duty will only have been paid on 50% of the value of the land, CIPT will apply to 100% of the land from 2037. On this slide, then we've got a practical example of indirect transactions, so landholder transactions that can result in entry or not into the CIPT regime. So here assume we've acquired a 10% interest before the CIPT regime commenced, say 30 June 2024. And then on the 1st of July 2025, we acquire a further interest. For both a company and a trust, the interest acquired, 40% or 10% respectively, is sufficient to trigger the landholder duty rules for a relevant acquisition, and landholder duty will be payable. For the company example, it also results in an interest of 50%, which is sufficient to trigger entry into the CIPT rules. However, that's subject to a legislative drafting anomaly, which may mean the 10% interest is disregarded and the property doesn't enter the CIPT regime. Now, we're still seeking clarification from the Revenue on this point, and we'll provide updates as and when we hear. But for the trust example, as I alluded to earlier, there's only a 20% interest acquired. So even though landholder duty continues to apply, the property won't enter into the CIPT regime. So the next slide, thank you. This example shows how the regime or the importance of the regime to look at each individual parcel of land. So here we've got an acquisition of a 50% interest in a landholder, and it has 100% of property A and a 50% interest in property B. So when we acquire that 50% interest in the landholder, we multiply through those interests to determine whether or not the property will enter into the CIPT regime. So here, property A 50% of 100%, obviously 50%, and that property will enter the CIPT regime. But for property B, where the landholder has only a 50% interest, that multiplies out to a 25% interest only in property B that's acquired. So that property will not enter the CIPT regime. Next slide, please. Now, I won't run through this slide, but here basically is a takeaway of a summary of those examples of when duty may and may not apply. Next slide. Again, a bit of information on this slide, and I won't run through it in detail, but an entry consolidation applies where there are 2 or more parcels of land that are consolidated. The requirement is to look at the total area of the consolidated property, and where 50% or more of that area was previously CIPT regime land, then the consolidated title will be CIPT land and subject to that tax. Conversely, if less than 50% is, the property won't be subject to that regime. And for subdivisions, the important point to note there is that the child title will take the character of the parent title. So whether that's in or out will be dependent on that parent title nature. Next slide. Thank you. So exit from the CIPT regime, again, I think best shown through a practical example. So let's assume land enters the regime on the 1st of January 2025 and stamp duty or landholder duty is paid. There's a subsequent transfer or landholder acquisition on the 1st of January 2026. And no duty will apply to that transaction because the land entered the CIPT regime in January 2025. But on the 1st of January 2029, there's a change of use and the property changes from a commercial or industrial use to a residential use. As this change of use occurs within 10 years of that transaction on 1 January 2026, the transfer is reassessed and duty applies, but there'll be a 10% reduction in duty for each full calendar year that the land remained used for CIPT purposes. So here it would be a 30% reduction. So in summary, CIPT is imposed on 31 December each year. The land must have a commercial or industrial use. The rate is 1%. The assessment must be paid within 14 days of an assessment notice. And if the land is land tax exempt, it will be CIPT exempt. The first assessments are expected to issue from early 2035. And as I mentioned earlier, the owner is generally liable for the tax, but unpaid tax can be recovered from a mortgagee, a lessee, or occupier. So if it's the mortgagee, they can add it to the loan balance. And if it's the lessee or occupier, then it's deductible from the rent. It will also be an offence to pass on CIPT unless the purchase price exceeds $10 million. So although for direct land transfers, vendor statements must show the land use code and whether or not the land is subject to CIPT and its entry date, this is not the case for landholder transactions. So purchasers will need to be reliant on due diligence and warranties and indemnities. So if we move to the next slide, we might have a quick polling question now that we've had a brief introduction to the CIPT. Based on what you've heard today, do you think that the replacement of stamp duty on commercial and industrial property tax with a 1% annual tax is better or worse for foreign investors acquiring property in Victoria? So do you think it is? Yes or not? No? Or is it too early to tell? Or you think you'd need more information? And while we wait for those responses to come in, we might just note that what we're hearing from our clients is it depends. For some that acquire property and hold for the short term or develop and flip, they think it's a good thing because their holding costs will be lower. But for the more longer term holders, say from more than 8 or 10 years, their view is it's not such a good thing because by then the tax is exceeding what they would have paid in duty. But perhaps if we've had results in, we might have a look at the results. There we go. So we need more information, which is not surprising and too early to tell, which, as I said, is what we're seeing. If we move on now to the next slide, just to finish off the presentation from my perspective today, I'll briefly cover recent changes to New South Wales corporate reconstruction relief, landholder duty, and wholesale unit trusts. So the next slide, thank you. The important thing to note here is that from the 1st of February this year, the full exemption from duty for corporate reconstruction relief was replaced with a 90% concession. And further, each step in a multi-step transaction that involves the same underlying New South Wales property will also be subject to that 90% concession, which will also apply to surcharge duty. All other corporate reconstruction relief requirements remain unchanged, and those general conditions are on the slide. But this means that rather than being exempt, each step in a restructure will be subject to duty of between 0.55% and, by the time the rate increases next year, 1.45% of the value of the underlying New South Wales property. We move to the next slide, thank you. From a landholder perspective, changes here was a threshold change for private unit trusts, where it's been reduced from 50% to 20%. And private unit trusts include all unit trusts other than listed unit trusts, widely held unit trusts, or registered wholesale unit trusts. And the linked entity provision was also amended to mean tracing now occurs through all entities in which a minimum 20% interest is held, rather than the 50% interest previously. Next slide, thank you. So the wholesale unit trust regime that was introduced also on 1 February when the changes to landholder and corporate reconstruction relief occurred. Key requirements there are that to be a wholesale unit trust, the trust must have at least 80% of the units held by qualifying investors, with no one qualifying investor holding 50% or more of the units. And the trust must be registered with the New South Wales Revenue Office as a wholesale unit trust. And a qualifying investor means one of a few type of investors on a limited list, which we'll briefly look at shortly. On the next slide, to register requires an application fee of $10,000 paid to the Revenue Office, and the registration will last for 3 years. The rules are complex. They adopt part of the Victorian rules and some of the Queensland rules. The key thing, though, is there's no almost discretion, unlike in Victoria, and there's no broad $10 million invested qualifying investor category like in Queensland. So next slide, thank you. I'm not going to go through this slide in the next few. They just a takeaway summary of the unit trust, wholesale unit trust provisions in these 3 jurisdictions. If we go to the next slide, this one gives that exhaustive list of what a qualifying investor is. And as you can see, mostly large super funds, listed entities, and life companies. And on the next slide, disqualifying circumstances for New South Wales and Victoria. The important thing to note in New South Wales, it's a penalty of up to 500 penalty units and twice the duty that would be payable. So you're looking in total at 3 times the duty plus penalty units if there's a breach. So that's all I was going to cover today from a state tax perspective. I'll pass now to Mimi to discuss changes to Australia's foreign investment framework.
Thank you, James. I will provide a very quick overview of the recent updates to Australian foreign investment framework. Next slide, please. When foreign investors make inbound investment into Australia, they may need approval from Foreign Investment Review Board. FIRB reviews the investment proposals and ensure there is no national security concerns, including tax revenue collection. On 1st of May 2024, the Treasurer announced reform to streamline and strengthen Australian foreign investment framework. Under the reform for low-risk investment proposals, from 1st January 2025, Treasury will adopt a faster approval process aiming to process 50% of the investment proposals within 30 days statutory period. However, on the other hand, for those high-risk investment proposals, which will face additional government review process, this includes arrangement consider high tax risk. For example, internal reorganizations, pre-sale restructure, as well as the use of related party financing arrangement. Next, we are going to discuss the proposed CGT reform. Next slide, please. Before we move into details, let's quickly recap the current Australian tax law. Under the existing rules, a non-resident investor is not subject to Australian capital gains tax unless if they dispose of taxable Australian property, which includes Australian land, fixture, leases, 10% or more membership interest in land-rich entities. From the purchaser side, they are required to withhold 12.5% of the purchase price unless the vendor declares that the disposed entity is not land-rich. This rate will be increased to 15% from 1st January 2025. Next slide, please. In the 2024-2025 federal budget, the government announced a measure to strengthen the foreign resident capital gains tax regime, ensuring Australia can tax foreign residents on gains derived from direct and indirect sales of assets with a close economic connection to Australian land and or natural resources. The proposed reform will apply to CGT events commencing on or after 1st July 2025. The consultation paper proposed 3 key changes, including first, clarification and broaden the definition of taxable Australian real property, amendment on the point-in-time principal asset test to a 365-day testing period, require notification to the ATO regarding high-value transactions. We will discuss each of those proposed changes in the next few slides. Next slide. The first changes is in relation to expanding the definition of Australian real property. Under the current legislation, real property is not specifically defined and takes its ordinary meaning. It generally includes land and assets fixed to the land and the common law as modified by the relevant states and the territory legislation. However, because the definition can vary by states, it creates uncertainty and different tax treatment across Australia. This reform will address these issues, ensure foreign residents are subject to consistent CGT treatments across Australia. The consultation proposed expanding the definition of real property to include assets that with a close economic value to Australian land or natural resources, which is a very broad definition. For example, the expanded definition will now include tangible assets such as telecommunications, energy infrastructure like wind turbine, solar panel, and batteries. The expanded definition also will include intangible assets such as water entitlements. Let's use one example to demonstrate the proposed changes. Next slide, please. So under the current Australian tax law, a direct disposal of an option over land by a non-resident will be taxable, but an indirect disposal an option over land through a company or a trust is not taxable, even though the option may represent 100% interest of the value of the shares or the units. Under the proposed reform, non-resident will be subject to Australian tax on both direct and indirect disposal of option over land, as which now fall under the expanded definition of taxable Australian real property. Next slide, please. For the second change, an entity will be considered land rich if it was land rich at any point of time during the preceding 12 months, rather than assessing at the time of disposal being the contract date under the current law. This proposed change could introduce several practical challenges. For example, it is unreasonable and impossible to test every day. It should be limited to a specific date or event. Another practical challenge is that the minority investor may not be in a position to obtain the underlying investment information for valuation purpose. Let's move to the third changes. Currently, if a non-resident sells shares or units and provides a declaration that the membership they sell is not land rich, the buyer does not need to withhold and the ATO is not involved in the sales process. However, under the proposed reform, if the shares and units are over 20 million Australian dollar, the vendor must submit a declaration for ATO review before the transaction date. The paper suggests that review could take up to 60 days, and the ATO might suggest withdrawing the declaration. We believe the 20 million threshold is low, and a 60-day review period is too long for commercial transactions. A shorter review period, like 28 days, would be suitable. The ATO should also consider the potential compliance burden and uncertainties when it designs the process. For instance, if the ATO does not respond within the review period, it should make it very clear whether the vendor's declaration is deemed accepted or the purchaser is required to withhold. Next slide. In the last slide, I've highlighted the key practical impacts. In summary, although the proposed changes are expected to have less impact on property sector compared to infrastructure and energy sector, there are still many uncertainties. A major concern is the broad new definition of real property. For instance, there is uncertainty about whether and to what extent certain intangible assets may be considered closely connected to Australian land and or natural resources, which potentially causing them to unintentionally fall under this expanded definition. Therefore, it's important for property sector players to stay alert and closely monitoring these developments. So I'm concluding my section here and handing over to Mandy. Thank you.
Thanks, Mimi. So that brings us to the end of today's discussion. So thank you to all the presenters today. But just before we wrap up, we do have some time for Q&A. So feel free to pop your questions in the Q&A chat box. And maybe I'll invite all the presenters to come back. So the first question is, what changes do you expect to come out of the BTR consultation? So Max, maybe I'll pass that on to you.
Yeah, thanks, Mandy. So there's quite a few submissions that went into the consultation process, including both technical amendments as well as some broader design issues. For example, there's a joint submission by the Property Council with the Community Housing Association and National Shelter, which actually called for the 15% rate to be reduced to 10%, along with expanding the affordable housing requirements to cover low and moderate income tenants as well. So it'll be interesting to see how the government responds to some of those, I think, combined submissions from the various kind of stakeholders. In the public hearings, the Treasury representatives there did specifically mention the sub-trust issue that we talked about before as one that they were continuing to work on with stakeholders, and so they're certainly aware of it, and so something might change on that one. There's also, unfortunately, been a bit of political noise around this bill as well. So the coalition, so the opposition, seems to be against incentivising foreign ownership of Australian homes, whereas the Greens are pushing for changes to expand the affordable component. So in order to pass this legislation, the Labor government in Australia will need to win the support of one of those two other parties, and that could also result in some changes.
Thanks, Max. So the next question we've got in is around the proposed CGT reform, and why is this still relevant to the property industry, given that land and buildings are already covered by the current tax law? It's Mimi, do you want to take that one?
Yeah, sure. Thank you, Mandy. Yeah, that's correct. Building, land, leases, that's already covered under existing definition of Australian real property. Therefore, that's as I flagged in the presentation that we anticipate the CGT reform is likely to have less impact on the property sector, but will have a material impact on infrastructure and energy sector. However, it's remain relevant for property sector. For example, in terms of the ATO notification process, if an investor disposes of a membership interest in an investment that is clearly not land rich under the current law, for example, an interest in an operating company, in a fund management company, or in a financing company, the vendor still needs to submit a declaration to the ATO for their review. Additionally, due to the very broad definition of a close economic connection to Australian land, some assets such as development agreements or financing agreement may be inadvertently captured under the expanded definition. So that's why it's still relevant for even the property sector.
Thanks, Mimi. The next question, James, I think this one's probably for you. So have there been any announcements or comments from other revenue officers around following the Victoria changes and shifting from stamp duty to an annual tax?
Yeah, interesting question, actually. So there haven't been any announcements since Victoria introduced the CIPT, but we have seen, of course, South Australia phase out stamp duty on commercial properties over a 3-year period about 6 to 8 years ago. And the ACT, of course, is on a 20-year journey of phasing out stamp duty and replacing it with like a local government rates, an annual tax. We then, of course, had New South Wales last year try to replace stamp duty on residential property with an annual tax, and that was very short-lived, about 2 or 3 months, and was then abandoned.
Thank you. So actually the next question, so could you please elaborate on the intermediate payment restriction for BTR concession, i.e. the head trust and sub-trust structure? So can this be managed by using the same trustee for both head and sub-trust? And so Max, could you take that one?
Yeah, certainly. So the way that it's been drafted, it's right to say that if the trustee is the same, then this problem doesn't arise. But in practice, the reality is that if you have a head trust and a sub-trust that's 100% owned, and you have the same trustee, a legal issue arises whereby, because the trustee and the beneficiaries are the same, what happens is it's called a trust merger. So the head trust and the sub-trust sort of merge together. And so for that reason, there's a very specific reason why you would not have the same trustee for the head trust and for the sub-trust. And that is why I think this is actually a real issue. And it wasn't something that the Treasury and the government, I think, were aware of, but they were made aware of that issue through the consultation.
Thanks, Max. Another one for James, is 50% land tax value reduction the same as 50% exemption from land tax?
Yes, effectively, that would be the same economic outcome.
Okay, thank you. I think we've got time for just one more. VIC vacant residential land tax for a property developer undertaking construction on a big piece of vacant land in phases. So there may be breaks in construction between the different phases for various reasons. How can the VRLT be mitigated?
Yeah, right. So I think this is asking what issues or how could that tax be deferred or avoided. I guess that the thing is the tax is imposed by parcel. So if the development is on one parcel of land, then you look to the dwellings that are on that land. Now, if those dwellings are predominantly or significantly occupied, then the whole parcel will be taken to be out of the vacant residential land tax. If you've got multiple parcels for each stage of the development, then the vacant parcels would be subject to that vacant tax, the 1% concession that is depending on where in Victoria it is, but assuming in metropolitan Melbourne, that 1% annual tax. And the idea behind that is to encourage developers not to land bank or sit on land, but to push through developments to bring on the housing in this environment where, you know, we're in a housing crisis, as Stephen pointed out.
Thank you, James. So we're about there now on time. So apologies if we didn't get around to answering your question live, but we'll come back to you. We can come back to you separately on these. So just to wrap up, so thank you to all our presenters today, Clen, Stephen, Max, James and Mimi, and a special thanks to all of you who were able to join us. We would like to encourage you to fill out the short survey that will pop up on your screen and tell us what you think about today's programme. If you joined us late, the presentation will be archived for future viewing on the Dbriefs website. And please also feel free to share the website via the share this icon to anyone you think might be interested. If you think of any questions or have comments later, please feel free to reach out to either myself or any of the speakers here today. We'd be more than happy to have a chat. And do join us for our next webcast on the 5th of September at 10 a.m. Singapore time in our geography update series, which will cover US 2024 election forecast and what to expect. So finally, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax webcast today. Thank you. Take care.
Thank you for your continued support.